Hi, this is Rishikesh Agashi. We will try to analyze the reasons as to why is everyone so bullish about the Indian stock markets in the following presentation. Everyone, including the media, the government, the share broking companies, the big bull Rakesh Jhunjhunwala himself, the FIIs and the HNIs seem to be bullish on the Indian stock markets. Let's try and understand the reasons based on the cyclical patterns in the stock markets. Attending the presentation will enable you to understand why it's a good time to learn and invest in the markets. You will be introduced to an amazing world of patterns in the stock markets. We will compare the patterns in the major world markets to understand where do the Indian stock markets stand or perform with respect to the other markets. So let's try and understand why is everyone so bullish about the Indian markets from a fundamental point of view. India is amongst the fastest growing countries amongst the emerging nations. After a long time, we have a single party democracy. A system in which a single party is constantly elected into power is a very efficient system, if used correctly, of course. Policy is implemented more quickly and efficiently in a single party democracy. We have the youngest workforce by far, which enables us as a country to be more productive. The Indian markets have been moving along with the global trends since a long time. The global trends look positive as of now, as we will observe in the slides ahead. We are expecting the Indian markets to break this trend and move up much faster than the global trend. India's GDP growth has been more than 2% of the average GDP growth of all the emerging nations, and still our per capita income is less than $2,000, whereas the average per capita income from the emerging nations is $10,000. Since we have the youngest workforce at this point in time, we may be covering up this gap pretty fast. We are going through a low inflation period, which will surely be helpful in taking the stock markets higher. Also, the quality companies are growing in India, and so are the billionaires, the good billionaires I mean. Now what are the quality companies? The companies with a market cap of more than $1 billion and are void of crony capitalism are known as quality companies. So these are some reasons which signify the potential in the market right now. So now let's talk on the stock market index. What does a stock market index mean? So let's talk about the traffic situation of a city as an analogy. The traffic on the main roads summarizes the traffic situation of a city. We do not look into the small roads when we talk about the overall traffic of a particular city. Similarly, the major stocks with a high market value decide the trend of the market. It would be clumsy to check each and every company, figure out if they are up or down for the day, and then give a detailed answer. Instead, I would just check a few important companies across a few key industrial sectors. If majority of these companies are moving up, one can say that the markets are up. If the majority is down, the markets are down. And if there is a mixed trend, you may say that the markets are sideways. When I say markets, I mean index. So what are the uses of having an index? What is the significance? The index represents the general market trend for a period of time. It is a broad representation of the country's state of economy. Uptrend in the index or the markets indicates optimism in the future of a country and vice versa. It can also be used as a yardstick to measure the performance of one's investment with respect to the index. There is a facility of trading on the index which is also used for portfolio hedging. So there are around 3 stock markets in India. I am listing only 2, NSE and BSE. MCX is not important because it's just a commodity market which I am not focusing on right now. NSE has Nifty as the index, and Nifty consists of 50 major companies. BSE, Bombay Stock Exchange, has Sensex as the index, and it consists of 30 companies. Similarly, US has Nasdaq, UK has LSE, FTSE, China has SSE, Hong Kong has Hang Seng. So this is what it is all about, a stock market index. In this presentation, we will be talking about the technical analysis, not the fundamental analysis. So technical analysis has two types of patterns. One is the cyclical or the periodic pattern, which occurs periodically, cyclically. Then there are non-cyclical or aperiodic patterns, which can occur at any point of time. So we will be analyzing the markets based on the cyclical or periodic patterns. Cyclical and periodic patterns are generally used for long-term prediction. Non-cyclical and aperiodic patterns are used for short-term prediction. So we will be analyzing one such cyclical pattern called the bubble chart. So we'll be looking at one of the cyclical patterns known as bubble charts. The x-axis represents the time, the y-axis represents the valuation of the market at any point of time. The bubble charts consist of 4 phases: the stealth phase, awareness phase, mania phase, and blow-off phase. In the stealth phase, the market doesn't move much. The movements are not noticeable to the general public. They move within a range in the stealth phase. Then there is a takeoff. There is a breakout from the range, which is called as the takeoff. The market starts rising, and then there is the first sell-off, wherein all the weak investors move out because they believe that this is the highest point that the market has achieved and the markets are due for a fall, so they move out. That is why it is called as a bear trap. Then the market starts moving up again, and if they are able to move above the value of the first sell-off, we say that the market has entered the mania phase. Now look at the kind of potential the mania phase has to earn money. From the starting value of the mania phase to the end of the mania phase. So from media attention till new paradigm, the market grows at least 2x to 3x and at times 5x. So once the market starts growing beyond imagination, there is a media attention that it gets. There is enthusiasm in the markets at the later stage, then there is greed, then delusion, and then there is a new paradigm that is formed. People go crazy at this level when the market rises to a new paradigm. And then it suddenly falls. Then that is where the blow-off phase begins. And how do you recognize the blow-off phase? The market falls, it rises again, returns to normal, and then starts falling again. This is the mark of the blow-off phase. So if it rises above the return to normal, if that value is above the new paradigm, that means it could be a first sell-off at a different time period. But if it does not happen, then the markets fall, there is fear, there is capitulation, there is despair, and then finally the markets return to mean. I have tried to map the Indian markets, the UK markets, and the US markets onto this bubble chart. So let's see that in the next slides. So these are the decade-long data charts for NSE, that is National Stock Exchange, Nifty. I have chosen a period from Jan 2000 till end of 2008, start of 2009. So if you observe, the stealth phase is not very clear because the markets are going down ideally, but then there is a channel that you see, that it goes in a channel. It is in a range bound. It's a range bound movement, although downward, but there is a range bound movement, and there is a breakout happening somewhere around end of December. The phases marked in this chart are approximate. They are with a tolerance of around 10 to 20%. No one can accurately predict the start or end of a particular phase, but you have a general idea. The basic logic behind looking at the phases is to identify the mania phase so that one can invest at the start of the mania phase and take out one's money at the new paradigm. So the stealth phase has a breakout. That is where I have decided, I have assumed that it enters the awareness phase. That's not very important as such. Then it rises. There is a first sell-off, the bear trap, as we saw in our last charts. Then it starts rising again, and the first, and where it breaks out into mania phase is the value where the first sell-off value is less than the current value. At that point of time, it enters the mania phase. And then you see the rise in the mania phase. It reaches new paradigm. Then the start of blow-off phase begins somewhere around 2007, during the time of world economic crisis. That started somewhere around mid 2007, end of 2007 to 2009. Then the blow-off phase, the market falls. There is a return to normal. Then there is a huge fall and the market returns to its mean. That is, and we have this data for NSE, so it's a proven concept that the bubble charts can be mapped onto the actual data. So this is a decade-long data. Now I'm trying to, in the next slide, I'll be mapping it onto the all-time data to see where do we stand at this point in time. So these are the all-time charts for NSE. I have taken the data from somewhere around 1990s till date. So if you observe the stealth phase, it's a range-bound movement, and then once there is a breakout somewhere around 2003, I have taken that as the start of the awareness phase in the markets. The market rises, there is a first sell-off. Now the blow-off phase on the decade-long charts is actually the first sell-off on the all-time charts. The market starts rising again, and once it breaks above the value of awareness, the first sell-off, we can say that the mania phase has begun. So I believe the mania phase must have begun somewhere around 2013, 2014 or 2015, somewhere around this. And we are currently in the media attention phase, because now the media, the social media, everybody is talking about the rise in the markets. So we are entering the mania phase. So if you invest money right now in Indian markets, I believe in another 5 to 10 years, you will grow your money by at least 2x, if not more, at least 2 to 3x. That is what my estimate is. If we choose the right stocks, we may grow our money more than that. Now let's look at the decade-long LSE charts. Here also I have tried to do the same. The stealth phase is a dead phase. It's like a range-bound movement. Then there is a bit of a breakout that sees the first sell-off, bear trap. The close above the first sell-off gives we enter into the mania phase somewhere around 2006. The London Stock Exchange entered into the mania phase. The markets rose huge, and then there was a new paradigm set, and then there was the blow-off phase. We started with the world economic crisis somewhere around 2008 in the same fashion. Now looking at the LSE all-time charts, you see that from 2002 to 2006 the markets were in stealth phase. After 2006 we saw a rise. It has entered the awareness phase. There was a first sell-off, as we discussed before. There is a rise. Somewhere around 2015-16 we entered the mania phase on the LSE charts, and right now the mania phase is on. So if you observe, we have been able to map the bubble charts onto LSE decade long charts and LSE all-time charts. So the first sell-off, the blow-off phase, the blow-off phase on the LSE decade-long charts is the first sell-off phase on the LSE all-time charts. So the periods are different if you observe. On the next slide, we are going to talk of the Nasdaq, the US stock exchange. So if you observe the Nasdaq decade-long charts, again the stealth phase, there is a range-bound movement, the rise, awareness phase, first sell-off. The first sell-off looks very small here, but I have taken it as the first sell-off because there has to be a fall and a bear trap to mark the first sell-off, and then there is a rise above the first sell-off, which marks the entering the mania phase. In the US markets, if you observe, the mania phase has been the shortest. It has grown around 2 times in the lowest time period. If you see all the 4 phases, there has been a 2x growth in the least time period, if you observe the time period on the charts as well. and then there is a fall, there is a return to normal, and there is a return to the mean that happens in the blow-off phase. So Nasdaq decade charts, this again proves that we are able to match the bubble charts on the Nasdaq decade charts. In the next slide we'll be looking at the Nasdaq all-time charts. So let's look at the Nasdaq all-time charts. Again, the stealth phase with a range-bound movement, rise into the awareness phase, the big fall that we observe that has occurred in the US. US markets have been there in existence for a longer time than any other markets. So the first sell-off in the US markets is marked on a different time period than the first sell-offs in the other markets. The second sell-off that we see in the US markets in the awareness phase is the actual world economic crisis that had happened somewhere around 2008-2009. But before that, there has been a big sell-off in US. We'll consider that as the first sell-off. Then the market starts rising. If this second sell-off if the markets would not have come up after the second sell-off, we would have assumed that this is the blow-off phase. But since they have, we consider that they are entering the mania phase somewhere around 2015-2014 time period. So now if you observe, every market, the major markets, world markets, there are other markets that we can compare with, but since there is a lack of time, I am just comparing the big three markets right now and trying to understand where India market stands overall in the world. So if you observe, the big markets in the world are into their mania phases. I have observed Hang Seng also. It has also entered into the mania phase. So if all the markets are entering the mania phase, and we have already seen that Indian markets follow the global trend, that means Indian market also is going to enter the mania phase. So this is a confirmation. If that is what we see, Indian markets are supposed to break the trend. That means if US market grows by 2x in the mania phase, we are expecting Indian markets to grow by 4x in the mania phase. So imagine the kind of return on investment during this time period.